Hello and welcome to another week of Nucleus Investment Insights. This week we want to have a bit of a dig through the reporting season, which has kicked off in the last few weeks, and just sort of have a run through some of the companies, what we're seeing, talking about what companies are talking about, and I've titled it a tale of triumph amongst turmoil. Hasn't been a lot on the earnings front to be excited about, but there's been some pretty big share price movements, and so. It's sort of a little bit of a disconnect. Just want to remind everyone that nothing you hear today is personal advice. Everything's general in nature. If you do want some personal advice, give us a call, book in a meeting, and we can have somebody to chat about your particular needs. But with that said, we will jump straight in and start looking at what's happening on the earnings front. So I'm going to try and sort of separate this into a couple of different parts. First of all, the sort of a quick overview of from the top down about what's happening. Then I want to dig into the Magnificent Seven. That's where most of the share price increases have been, and just talk about some of those stocks individually. And then we'll dig on to some of the other sectors, what we're seeing in some of the other sectors, and what we might be able to gain. Glean from what the early reporters have been talking about, and whether that's going to start affecting other companies as time goes on. So I'm going to jump back to start with the this slide we show quite often, which is just a look at forward earnings. So the red line is like a rolling 12-month forward, sort of always looking 12-month forward at what's going on. And then the blue lines are the individual years and what's happening with that. So the second last sort of blue line from the right, and for anyone listening in, we're basically looking at a blue line that sort of went up for a bit, and this is 2023 forecasts, and then fell quite significantly right throughout late 2022 and into 2023. And then once it hit sort of mid last year, it basically stopped and just stayed there for the rest of the year. So we saw considerable downgrades, and then it stopped. And we've seen and basically 2023 numbers were in line with 2022. So actual earnings really haven't gone anywhere yet. This is all about the forecast. So we've seen we can see that red line rising quite rapidly. So forecast earnings, 12-month forecast earnings have been going up significantly. But that's been because 2024 forecasts have been so optimistic, and now we're starting to get now we've got 10 and a bit months, 10 and almost just under 11 months worth of 2024, and starting to look at 2025, and earnings are really quite even more optimistic for 2025. So I'll jump in though pretty quickly into the other factor I want to talk about is share price performance, and in particular, what's sort of working. What are the elements that have been working in this reporting season? Now, I've got a couple of different charts up, just sort of showing different style, what we call style factors. And so I've spoken in the past about the different quantitative ways you can try and dice up the market and look at which stocks are going to perform when. And what we're seeing very much is that following to this reporting season and following on from January, is that quality stocks are the ones that are outperforming. And so they're the ones that have got high margins, that have got what you call a moat. They're ones where analyst expectations are managing to hold up or increase. And what we're seeing at the other end of the scale is some of the smaller companies and the cheaper stocks, so what you call value stocks, are the ones that are underperforming, and that's true both in US and Europe. And the reason why for that, as I've spoken a few times about on prior podcasts, is that this is sort of how we're trying to organize our portfolio at the moment, is trying to get as much quality as you can. So they're the stocks where we've seen inflation run up, and you've seen that most companies have managed to increase their sales and increase their prices, and now we're looking for the companies that are going to be able to hold on to that. So what you notice is that the value stocks tend to be the ones that are more commodity-like, and so they might be selling, say, tires or cars or something like that, where there's lots of competition. And if one player comes out and starts trying to cut prices, they all have to follow, because otherwise they lose a lot of market share. Whereas the quality ones are more companies like your Microsofts and ones like that, where they've got a price and really they're not really affected by what others are doing out there. And they don't look at their market and go, well, if I cut my price, I can pick up all this extra market share. So, yeah, so those quality companies, and that's certainly what's been working so far in this reporting season, and that's where we're expecting that to continue. And so, that's certainly where we're trying to position our portfolios, is away from the value stocks and more into the quality stocks at this point of the cycle. There'll be time for value, but yeah, typically it's not, as you're seeing falling inflation. So the other thing I want to come back to is looking a bit more specifically at the numbers. And so I've got a chart up now showing where we were in 31st of December in terms of what people were expecting for the fourth quarter numbers, and then where we are today. So not a lot of change. So we've come in at about 1% lower than what expectations were a month and a half ago. So nothing too dramatic. We'll note that the Magnificent Seven really haven't changed. It's sort of been a tale of two parts. That Magnificent Seven really haven't changed much in terms of their earnings forecast. We've seen actually a fair bit in terms of Japan. Some of that's a currency translation, but Japan has been a relative outperformer in terms of earnings for this reporting season, and then pretty much everywhere else has seen earnings down. And so and I guess I should also take that step back just to talk a little bit about how I tend to look at reporting seasons. You see a lot comes out in terms of whether companies are beating their forecasts. To me, that's a bit of that number is a made up number. So what will typically happen is companies might be forecasting, say, whatever, they earned $100 last year. They're forecasting they're going to earn $105 this year. And then they get to 31st of December and they've pretty much got all the numbers. They know what they've done. They can look at their numbers and they'll come out and quite often put some guidance to the market, whether explicitly or to, it might just be in sort of general conversation with analysts in terms of sort of the conversations around, wow, your numbers look really high, that type of thing. And analysts sort of can read between the lines and cut their numbers back. And so what you see is that 105 drifts down to 102. Sometimes they might even come out with an announcement and talk about, they're going to come in with numbers like that. And then on the day, rather than 102, they actually come in with 103. And then that's called a beat, despite the fact that, a month and a half earlier, numbers were significantly higher. So there's a whole game that gets played in terms of the numbers. And I just find that the beats and misses is just, it's too, there's too much game playing and too many redefinitions of numbers and all that type of stuff to take much heart from it. There is more in terms of the forecast, though. That's what I tend to look at as a much stronger indicator, is saying, well, a company might come out and explain how great it's been and how it's beaten its forecast, but if everyone's downgrading their forecast for the next year or 2 years, then that wasn't a good result. And that's where the next chart comes into play. So this is now what was expected for the first quarter earnings, and I've broken it up again sort of by region and split out that Magnificent Seven. So now what we've seen is a pretty reasonable downgrades to the numbers. There was a month and a half ago we were expecting, or analysts were expecting, a bit over 3% earnings growth, and now it's below zero for first quarter earnings. We've actually seen some upgrades in terms of the tech companies. So that Magnificent Seven has seen earnings. They're expecting higher earnings now, but everywhere else pretty much has gone and seen some quite significant downgrades. And in particular, the US, excluding that big seven, has gone from adding 1.5 or a bit over 1.5% to world growth to now deducting from world growth. And so, and that's, we've spoken numerous times on this podcast about the issues with 2024 earnings, and that they have to come down along exactly those lines. That the big seven might hold up, but other companies within the market are going to see downgrades, and that's exactly what we've seen so far, and even more so when we're looking at the 2024 numbers. So big downgrades. We've sort of at one stage there, I've got it just before, I've got it at 31st of December just to sort of match up, where analysts were expecting a bit over 9% growth, 9.5% growth. You don't have to go much further back again, and you're over 10% growth that was expected for 2024, and now that's down to just under 6%. So we've seen some pretty reasonable downgrades to 2024 numbers, which is sort of the that's the paradox in terms of we've seen markets quite strong. In terms of prices, but the earnings is X that Magnificent Seven has been quite weak, and I'm sort of in a way I'm surprised it hasn't had more attention at this point. Potentially as it keeps going and we see further downgrades, that will be the case. But the market's largely been looking through any of the problems at the moment. The only other thing I'd worth noting as well, 2025 earnings. So depends on how you look at it. So that's starting to become a factor now. So there's about 12% forecast at the moment for 2025, and that's actually increased over the growth rate has increased from 31 December. So it's gone from 10.8% to 12% growth forecast. Now, this is one of those weird ones I've spoken about a few times again, where what happens is analysts downgrade their 2024 numbers. So they roll into they've just finally got their 2023, and they have a look at that, and then they start having a bit more of a look at the 2024 and go, they're not going to make that, and so they've downgraded their 2024 numbers by say 5%, and then they've downgraded their 2025 numbers by 3%, and the net effect is, yes, 2025 numbers have come down, but the growth rate between 2020 because you've pulled down that middle year, the 2024, by more than what you've pulled down the later one. The implied growth rate that you sort of put into your numbers has actually increased, and that's that paradox that sort of pops into these things, and that'll go away in a few months' time. But it's quite common to see that. It's not sort of a sign of it's not a positive sign for 2025. It might not it's not necessarily a negative sign at the moment, but it's more of a sign that particularly in the US there's a real short-term focus, and the later years are less. There's much less focus on it from analysts in particularly the US. A lot of that's really just about the next quarter and what's happening there. So we'll go to a quick message, and then I want to come back and talk in detail about what's going on in that big seven.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so the Magnificent Seven is made up of Apple, Microsoft, Alphabet, which is Google, Amazon, Nvidia, Meta, which is Facebook, and Tesla. So so far, we've seen pretty reasonable price rises in them. So Nvidia's up 42%, Meta's up 33%, Tesla's gone the other way, down 25%. And then I've got a chart to sort of a table to sort of showing as well what's been happening in terms of the earnings forecasts. So what's interesting when you look through this is And I'm going to jump through each one of these individually just to sort of talk about what are the key themes that are sort of flowing through. So Apple is actually I might start at the other end. Actually, I'll start with Tesla. So Tesla is running into some earnings problems. So it's always been expensive. It's Tesla's sort of been it's been worth more than every other car maker combined. Most other car makers trade on very low multiples. So, we have market, price to earnings multiples of sort of 20-ish times, and most of the car makers are below 10. So they're sort of half the price of the market, and often on single digit price to earnings ratios. Tesla's sort of priced on 60 times next year's, and 43 times the year after that. The issue in terms of Tesla is they've got to keep getting that growth, and in the last couple of quarters they haven't. Their actually growth's been going backwards. There's some pretty reasonable price wars breaking out in China in particular on electric vehicles, and they look like they're going to spread to other countries. You've got Europe looking at putting on tariffs from cars produced in China because of dumping and government subsidies. You've got issues with the US putting tariffs as well. There's a lot of moving parts within that sector. Now, electric vehicles themselves have actually been growing pretty quickly. It's one of you might read a lot of articles and see a few things around at the moment about overstocking and how car yards can't get rid of them. They've got too many, cancelled orders, all this type of stuff like that. And some of that at face value, you look and go, EVs aren't going well. And this is a part about it's trying to work out expectations versus actual results. So actual sales of electric vehicles are up a lot. There's a lot of countries where they're up 50-odd%. The issue is car companies were factoring in 60 or 80% growth, and so they'd stocked with all these extra cars, and now they've got all these extra electric vehicles. And so there still is strong growth in that market. But it's a question about expectations and how many other companies are now trying to force their way into that market, and that's sort of been Tesla's main issue. I guess the question for them, coming out of this is issues with China, between China and the US is obviously cropping up and starting to flow through to other companies. Tesla's managed to avoid that, so if you're positive on Tesla, you sort of got to assume they're going to keep managing to avoid those pitfalls. You got to make some assumptions that they haven't gone X growth. This is just a blip, and that you're actually going to see some really significant growth coming out of Tesla going forward. The issue with that is that because I guess if you looked at Tesla and said they're just another car company, that's it. They've had their growth. They've picked up their market share. They're going to keep growing, but their margins are going to shrink now as everyone else tries to make EVs, and they're going to come back to sort of a more normal. Look more like one of the other companies. Well, the other car companies, even if you assume that they get another 30-40% growth into a few over the next couple of years, and then they settle down, if you put them on the type of multiple you see on other car companies, the share price is still going to be down about 70% from where you are today. So you need to make sure that if you're keen on Tesla and a holder or want to buy it, it's definitely the company you need to be looking at the current earnings and the weakness in the earnings and assuming this is just a blip and it's about to take off again. It's not a stock that sits in our portfolios. I'm certainly positive on the growth of electric vehicles. Just given the prices you pay for Tesla and how it sits in the rest of the market, is you've got to have some pretty aggressive assumptions behind it. And the other thing with Tesla as well is that in terms of driverless cars, they're actually probably further behind than what many might think. That Tesla looks to have the best driver assist systems out there, but some of the worst full driving within their cars. And so what that and the issue though as well is there's a little bit of a catch-22 in there. Is if you do think driverless cars are going to take off, then chances are we're actually going to need a lot less cars. Most driverless, the expectation is driverless cars will sort of run as taxis, and whereas the average car does sort of 10 to 15,000 kilometers a year, the average driverless car is going to do more like 80 or 100,000 kilometers a year as it sort of drives around all the time. The issue for that is for every driverless car that's doing 80,000 kilometer, that's going to replace 6 odd cars, and they just literally won't need to make, and so there's going to be those issues with that. If you look at Apple, sort of falls a little bit into this same sort of path. So it's relatively expensive as well, particularly from where it's been trading at over the last few years. It's been trading much more in a market multiple, and we've seen earnings downgrades coming through for 2024. Price hasn't been particularly strong. There's bans within China about who can use Apple products, particularly in government organizations. There's it's certainly it's looking expensive, and there doesn't look to be a lot of growth coming out of it, and certainly not in the way of upgrades. Alphabet, they actually had a pretty negative result. Surprised a lot of people on the downside, and the price fell quite significantly. The price is actually still up over the last month and a half. And earnings have actually been up. We've seen earnings upgrades as a net result to 2024. It's not particularly expensive. It sort of trades on about a market multiple, maybe a little bit below a market multiple. And then the question for them, very much is can they keep getting? Are they now so big that? Actually, let me take one step back. For the last 10 years or so, there's been this immense push of advertising revenue from traditional media sources into online. And so what that's meant is that Google and Facebook as well have managed to grow their earnings without seeing a lot of the cyclicality that you typically see in that whole advertising sector. And within that advertising sector, if you look at traditional media companies, it gets... it's very much a boom bust sector. When things are going well, people throw lots more money into advertising. When things are going poorly, it's very easy to cut your advertising budget. Much harder to fire people or to close down offices or things like that. But whereas an advertising budget, can turn on a dime. And so typically you see media companies and companies relying on advertisers for revenues having very volatile and very cyclical earnings. Now, the question with Google and Facebook is whether they're going to start seeing more cyclical earnings just as they get bigger and bigger, and more, the internet, they stop having that rising tide of as much revenue coming across from offline onto online every quarter that's sort of helping them along. Meta was a booming result. Significant upgrades. It looks a little bit more expensive than Google, sort of 10% more expensive, say. But we've seen some significant upgrades, sort of 12% earnings upgrades, and the price was up, roughly about a third from the start of the year. The issue with Meta is that they're spending a lot of money on the metaverse. There's this huge spend where they're spending billions and billions of dollars and getting absolutely no return for it. And so Meta's really this question about saying, well, how much do you think of the earnings that they're doing, how much of it, how much should you take into account that metaverse? So if you just said, okay, that metaverse is worth, I'm going to value that separately. I'm going to take its earnings and stick it somewhere else, and I'm just going to look at what's left within Meta, is that you could get the price earnings from a 10-15% premium to the market. It would go down to a 30% discount, so it would be trading on sort of 14 times earnings if you cut out that spend that they're spending on the metaverse. So that sort of core business of selling ads to people on Instagram and Facebook is very, very cheap. Then there's a question about how much do you value that part of it, and so came in with some relatively some good numbers there. The other one we saw coming in with good numbers was Amazon. So it looks like the AWS part of that Amazon, which is the cloud computing. So actually, I should take one more step back as well. Amazon's this company that really sits in three parts. So what you've got is you've got an international part of Amazon, which basically doesn't make any money and has pretty much never made any money. It makes lots of sales, so I think it's sort of 100 billion plus a quarter in terms of sales, per annum in sales, but it's just doesn't make any profit. Then you have the retail part, so the biggest you have the same Amazon retail website within the US. Now that varies between not profitable at all and very profitable. Its latest results, its margins were actually well above what you see. It's gone from having margins below in most of their competitors in terms of your Walmarts and those types of companies and Costco's to miles above. And there's this real, it's always been sitting on this part about saying, what's the right margin for this company in the long term? Are they going to be able to earn really high margins? Or actually, do they need to keep their margins really low? Otherwise, they're going to lose business to competitors. And so the last sort of quarter or two, we've actually really seen some expansion in the margins. And the question now will be very much, did they go back to shrinking the margins in order to get more growth? Or is this a new, into a new sort of paradigm of higher margins? And then the final part of that business, and then, sorry, in terms of talking about the margins, often in the past, the margins have been below 1%. So they might be doing 300 billion worth of sales, but they're making below 1% of that as an actual profit. And now the traditional, your traditional competitors make more like 2%, 2 to 3% in terms of the margins. And so will they go to there, or will they go to where they did for the last quarter or two, which is much higher than that again? And that's the real sort of question, sort of feeding back onto Amazon. And then they've got this rocket ship of AWS, which is the cloud computing, and that does 50% plus margins. It's been growing at 15 to 20% per annum every year for the last few years. It had a bit of a tough year last year, but it looks like in the last couple of results that seems to be resolving itself, and that's why we've seen Amazon sort of up. So Amazon looks expensive, but it really comes back to this question on the margins of whether they can hold on to those. And then finally, Nvidia. Oh, sorry, actually I should talk Microsoft first. Microsoft, solid earnings upgrades. It's expensive, but one of the highest quality stocks in the market. It's got great exposure to AI. It's got great exposure to cloud computing. The biggest problem really with it is that some of these sectors it's got, like AI and cloud computing, are great and are seeing great earnings growth. They're just really small as a factor of the overall company. So yes, they might be growing these things at 20, 30, or maybe 100% in the AI space. But the problem is the company is so big that they just need it just doesn't make as much impact on the overall company. And so so very high quality company, but really looking expensive, or starting to look expensive. And it's now down to a question of how much you want to pay up for that quality that you're getting, and the exposure to those growth areas. And then your final one, Nvidia. Now Nvidia is interesting in that the price shot up 40% since the start of the year. Earnings growth actually hasn't changed. So, sorry, earnings, their absolute earnings targets for 2024 haven't changed. Now, it's there's some moving targets here. So every year as we get closer, they've got this massive growth sort of factored into their earnings numbers now. And so if you look back over, say, the last 4 or 5 years, we're looking at earnings numbers are going to be sort of 7 to 10 times higher than their traditional earnings. So earnings are rocketing up, and every year that goes past and every quarter is way better than the prior one. So you're seeing this great growth come through. But what we didn't see over the last couple of months was any increase to those forecasts. So that might still come, but for the moment, those forecasts have sort of stayed where they are. So the question then comes back to, what's the right multiple to pay for this company? If they're going to keep 90% plus market share in their chosen space, and if that space is going to grow at leaps and bounds, then they probably look maybe fairly valued. The question for me is, they could maybe not get a 90% share. They might end up with a 60% market share, and then they start looking quite expensive from where they are today. And then possibly as well, the growth might slow a little bit, or will likely slow. I think in this is a second part within that sector, and then the final part is it's a nasty industry. It's an industry where the people buying from you, and in particular the data centers, really don't care that much about brands, and there's not a lot of loyalty. You're as good as your latest chip, and if your chip is no longer the one that's the most popular and the fastest, or even if it's not even it's a mixture between price and speed. So they've got this premium price to get to pay at the moment, but if one of their many competitors comes up with a chip that's 30% slower than theirs, but 50% cheaper, then a lot of data centers will look upon that as a viable competitor, or at least use that in order to drag the pricing down for Nvidia's chips. And so for Nvidia, fantastic price growth, but every year or every day that goes past, we're one day closer to these massive earnings that we're seeing that we're seeing coming down the line within Nvidia, but there haven't been upgrades over the last little while. So that potentially that price jump we've seen is a little more reacting to the actual numbers coming through, and less about things improving and getting better over time.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so what else is going on? So there's as I said, it's sort of dominated by downgrades. There really have not been that many upgrades to 2024 numbers. And significant downgrades for a lot of sectors, down 15% plus for a wide range of companies. Now, some of the ones I think are probably worth hitting on is the energy sector. In particular, has been we've seen some significant downgrades in that. So prices have obviously been weaker, lower energy prices, lower gas prices, particularly in the US, and certain assumptions that people are making. And so so energy earnings down a lot. Autos has been pretty mixed. There's been a couple of ones with significant upgrades actually, but the auto sector more generally, we've seen some significant downgrades. And that sort of flows through into the semiconductor space as well. So semiconductors, mixed. I think you'd find ones that are sort of more general. Ones like Intel had a very tough quarter. A lot of the ones that are focused on cars and chips that are sort of going into that markets are seeing downgrades. Lots of downgrades within that area. The ones more focused on phones and chips into phones has sort of been okay. A little bit of downgrades, but nothing. A little bit of downgrades, a little bit of upgrades. There's sort of nothing too dramatic within that. The general sort of semiconductors that they're supplying through to the phone market, and then the ones to the AI market generally up a little. But yeah, sort of a very mixed market in terms of the semiconductors, really depending upon where the main focus of each company is. Luxury goods, we've seen a bunch of different luxury goods companies with significant downgrades to their earnings. Some of within the healthcare part, and particularly the insurance part, there's the US insurance part of the healthcare market, which is quite a large sector. We've seen some relatively positive results from a couple of them, and then one of the major players, Humana, had a big downgrade and a lot of warnings within that, and so that sort of raises some weird questions for the rest of the sector. It's still trying to work out whether that's something specific about that company. In the past, they've been pretty good, and they are talking about a lot of their issues as being sector-wide issues. But yeah, so we've got some question marks on some of the other companies within that sector. I spoke a little bit about luxury goods being down. The transports are generally weak, especially a lot of the trucking companies and some of those early reporters. We've seen those come in weak. UPS came in with some quite disappointing results. They're often seen as a bit of a bellwether for the goods sector. We've still got their competitors though, Deutsche and or DHL and FedEx to come through. So keeping an eye on that. But yeah, there's with a lot of these, it's sometimes you see one company come out with quite a poor result, and then the other companies in the sector be fine, and so it's sort of obviously more of an indication that there's specific issues at one company. But what we're trying to do very much is see whether we can draw assumptions through from these into other sectors. And at the moment, as I said, just a number of downgrades versus a rising market is the most surprising sort of factor I'd talk about coming out of this reporting season, and it sort of raises these issues that what is the market doing in terms of, or how's the market looking at these earnings, and what's sort of the future your future path for it. So that sort of fades into our question of the week. Can the market keep ignoring these falling earnings? And I guess that's something for people to have a comment in the notes in the YouTube comments about that. The issue for me, and this to me is going to be the key issue for 2024. We're looking at falling inflation. By and large, the companies that have more positive outlooks, or certainly the ones that had more positive outlooks last year, the commentary tended to be, we've managed to get this certain sales growth. We're really but we've had all these costs come through as well. Now we're really noticing the costs is easing up, and we think that costs are going to, be flat or might even fall a little bit, and we'll get our sales growth through, and then we're going to grow our earnings. That was what we're hearing, as a broad brush from a lot of companies last year, and that was the part where there's a cognitive dissonance there, where you're like, well, your costs are somebody else's revenues. Every company's cost is another company's revenues. And so if you can't have every company with keeping costs down but managing to grow revenues and growing their sales. And so it sort of seemed to us that that would actually then flow through into lower earnings, which is what we're seeing now. The thing is, we're not seeing the market react to that. Now, can we see a situation where over the next, I think we're going to see weak earnings and probably negative earnings this year. Maybe it'll be offset by some of some of the biggest stocks, but maybe not. And at some stage, though, over the next 3 or 4 years, there's probably quite reasonable growth in terms of a number of these productivity factors really starting to flow through into companies. And we go through some downturn at the moment and higher inflation rates, and then you'll come out the other side of that, and you probably see some pretty reasonable earnings growth coming out the other side of that. Now, if markets are going to keep looking through that sort of downturn in earnings, then maybe we can see markets headed sideways for a while. But it's certainly it's certainly interesting that we've seen some pretty reasonable downgrades and without seeing much sort of effect on that broader market. So the question for me is, well, will there just be the weight of downgrades as we keep seeing company after company after company? It's been smoothed a little bit because companies have been coming in with sort of results that aren't that bad. So they're sort of like basically saying, fourth quarter was roughly what I told you it was going to be. First quarter is going to be much lower, and the whole year is going to be much lower than what we otherwise thought. But markets have sort of largely looked through that, and so the question for me is, will we get this? Eventually, the weight of downgrades will then see the market fall, or maybe that's just it'll look through this. The market will just get more and more and more expensive, and then eventually earnings will start to recover, and at that point maybe we can see some further upside into earnings. So that's the key factor to be looking. I would have expected knocking 5% off 2024 growth would have been enough to at least see the markets retreat a little, but it hasn't so far, and that's what we're going to be watching into the coming months. So jump on the YouTube channel if you want to have a talk, put your thoughts about those about those earnings. If you're looking to get more Nucleus Wealth content, we're on a whole bunch of different platforms. You can get our videos and our podcasts on most of the major platforms, Google Podcast, Apple Podcast, Spotify, YouTube, most of the minor ones as well. We're semi-active on some of the social media, and if you head to Nucleus Wealth /content, you can get more information from us. And with that, I'll wind it up, and we'll be seeing everyone next week. Thanks.